One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. Yeah. All right. Welcome to Investment Banking Insights, the only show dedicated to helping you learn both the technical and non-technical aspects of investment banking. My name is Alex Mason, and I am your host. Thank you for joining me today. I hope you're having an incredible day. I just had a really good day up here in Ithaca. I mean, just, Friday, just enjoying life, trying to, manage all the craziness of recruiting with classes, with the social life. I mean, it's a little wild, but I'm having a blast. I hope you had an amazing day too, wherever you are in the world, whatever you're doing. Thank you for listening to the show. We're here talking about technicals now. We've gone back to accounting and we're just going through some advanced concepts now. We've gone through the basics. We're going through the advanced concepts. And last episode, we talked about how do you build a revenue model. And it was interesting because there was this bottoms up approach as well as this top down approach that we talked about. But now we're going to talk about an expense model. So not revenue, but expense model. So the question is, walk me through an expense model. And the way that I think about this is it's kind of similar to how a revenue model looks at a company's potential for generating sales. But the difference is the expense model looks at a company's potential future expenses. So you can just kind of see this as like two sides of the same coin. So a business is going to have some kind of future financial performance, right? And that's going to be dictated by a number of different variables. But in simple terms, it's going to have a certain revenue growth and certain expense growth. And then the difference is the profit. And you can derive like free cash flow, all those kinds of things from those various assumptions. But on the expense side specifically, how do we think about building up that model? Well, we can think about it from a bottoms-up approach, similar to how we can look at a revenue model from a bottoms-up approach. We can look at an expense model from a bottoms-up approach as well. And so we can think about what are the individual components of this business that are needed to keep it going. And the way I personally think about this is in terms of kind of like microeconomic terms, where you have fixed costs versus variable costs. So you have your fixed costs of the business that need to be considered. So think about things like your rent, your facilities, your equipment, the things that regardless of how many customers walk in the door, you need to pay those bills, because if you don't, then you don't have a business. So that's one thing that I think about. But I think the more interesting aspect of this question are really the variable costs, specifically the number of employees. The number of employees of a business will usually correlate with the level of revenue. Now, of course, it's very, very different depending on industry. For example, Google, an internet firm, is going to make much more money per employee than, say, Caterpillar, which is a firm that manufactures construction equipment. And that's just because of the economic nature of those two respective industries. But, let's remove that complexity for a moment and just assume here that employee or headcount growth scales with revenue growth. So we would think about this as one of our first things, like how many employees does this company have? What's the expected number of employees that they're going to have in the future? Then what we can do next is think about how much those employees cost. So you work at a job, most likely, and you make a salary, most likely, and you have some level of benefits, or maybe there's a bonus as part of your compensation that you draw in. And those are all pieces of revenue for you, but they're costs or expenses to the company. And so, from the company's perspective, you also want to think about what are the salaries, bonuses, benefits, other compensation that are being paid out on average per employee. What's the cost of your average employee? And then you can take that average cost per employee, multiply it by the number of employees, and then you can get a certain level of assumptions as far as overall expense of labor. So that can go into your expense model. But remember, most businesses don't run just off of labor. They need other kinds of assets, they need other kinds of things going for them in order to be successful. And that's where we look at another line item from the income statement, which is cost of goods sold, or COGS as it's abbreviated. So think about the COGS. This is also a variable cost that's going to scale with the amount of products or services that's delivered. So think about COGS and how that's going to change over time. And when thinking about each of these items, be sure to make assumptions about their growth. Okay. That's going to give you better forecasting about what the overall cost of a business will be in the future. If you just say, yeah, I think the COGS are this amount and it's just going to be like this forever. Well, that's not really realistic because you have inflation, you have different things changing in the marketplace. So think about your COGS increasing at a certain percentage rate, growth rate. Think about your headcount growth and your overall salary and total compensation expense growing at a certain rate, and build those into the model. That way you can get a clearer picture of what the costs truly look like for this business going forward. And then once you have that, you can then begin to make certain assumptions about the value of the business, maybe tie that in with a revenue model, etc. So those are some things just conceptually that you and I can think about when someone asks us that question. Walk me through an expense model. So the bottoms up approach, I think, is the way to go here. At least based on my research, that's what it seems like. Okay, that's what I got for you today here on Investment Banking Insights. Again, I hope you're having a wonderful day. I wish you the best. Enjoy your weekend, and I'll see you next time here on the show. Take care.